Good day, grade 12 learners. This presentation is about the analysis and interpretation of financial statements, and it's going to be looking at one important concept. The concept we're looking at today is that of net working capital. A very important concept because our working capital gives us an indication of the cash available for our operations. If you're asked to calculate the net working capital, you need to subtract your current liabilities from your current assets. Ideally, what a business would like to have is a positive working capital, which means that there's enough current assets to pay off our current liabilities. There are a number of financial indicators relating to the control of my working capital. When you hear the word working capital, you should get a sense or a feeling of certain things in a business, right? And what I want you to think about when you hear the word working capital is my stock, my debtors, and my creditors. Stock, because essentially operations is about buying and selling of stock. And if we are buying it on credit, we will have creditors. If we are selling on credit, we will also have our debtors to consider. So now let's look at those financial indicators which are related to, or which speaks to my net working capital. Right, there they are. Remember I said working capital, think about your stock, think about your debtors, also think about your creditors. So the financial indicators relating to the control of my working capital is the stock turnover rate. In other words, how fast is the stock being turned over in this business? What we really want is for our stock to be turning over at a rapid or at a suitable pace. Now, this will be determined by the type of business. For example, if I'm selling fresh produce, then my stock turnover rate will be very different to a company selling furniture. Do you get what I'm saying? So the type of business is important for when you analyze and interpret our stock turnover rate. The period for which enough stock is on hand is also important. Remember, we want to be able to sell to our customers. We do not want a situation where we're running out of stock. On the other hand, we also don't want months and months or years of stock on hand, because then a lot of our working capital is being tied up in stock. Okay, so you need a suitable period for which enough stock is on hand. Okay, that's dependent upon the type of business we have. Our debtors collection period. Ideally, we want our debtors to pay us within the terms of this business. A lot of companies go into a credit term period of 30 days. So, are our debtors paying us within that period? That is how being determined by the debtors collection period. And then finally, our creditors payment period. How long are we taking to pay our creditors? Now, when we are looking at how to calculate these, let's take each of them. Our stock turnover rate, how do we calculate that? We take our cost of sales and we put it over our average stock. Average stock is half of the stock that we had at the beginning of the period and the stock that we have at the end of the period. The period for which enough stock is on hand, we just do the opposite. We are now turning it upside down. We take our average stock over our cost of sales times 365. Now, why times 365? This indicator, the period for which enough stock is on hand, as well as the debtors collection period and the creditors payment period, is normally calculated in days, right? So that is why we multiply by 365 days. In the case of debtors collection, I take my average debtors over my credit sales times 365. Creditors payment period, I take my average creditors over my credit purchases, which is generally your cost of sales, and you times that by 365. Now again, you don't really have to study these. Can you see the similarity? These last three is virtually the same. Average stock, average debtors, average creditors. Over cost of sales, over credit sales, over cost of sales or credit purchases. And all three is times by 365. So please, learners, try and reason these out. Try and reason these out so that you don't have to rely on your memory for the calculation of these financial indicators. Okay, so I trust you now know exactly what working capital is, and if you're asked to comment on the working capital, you would know which financial indicators you would need to look at. All the best, and I trust you will remember and continue working on these financial indicators. That's all for now.